The Firm, India's only show on corporate law, tax and audit matters.
Hello and welcome to The Firm. This week the show comes to you from Davos, which is hosting the World Economic Forum's annual meeting for the year 2016. It's been an action-packed week, and we'll talk a little bit about all the issues that are concerning delegates here. But first, let's tell you what's on the show tonight. How investor-friendly is India's revised model BIT? And will the Ishwar Committee's recommendations simplify India's tax regime? This is the second year in a row that the Indian government has splashed Davos with Make in India billboards, inviting foreign investors to come invest in India. Well, last month, the Union Cabinet cleared a revised Model BIT, or Bilateral Investment Treaty. Does this revised version give foreign investors investing in India increased protection? Aayush Ailawadi finds out.
The first thing that one notices with the revised model BIT is a much broader enterprise-based definition of investment. In the last draft, investors were to satisfy certain ownership and control tests, which have now been done away with. The model BIT requires investments to have specific characteristics, such as the commitment of capital or other resources, certain duration, the expectation of gain or profit, the assumption of risk. The definition still doesn't include portfolio investments, interests in government-issued debt, court judgments or arbitral awards.
Well, many BIT will start from an asset-based definition, so you will look at investments comprising assets and then look at what those assets could include, and that would include enterprise. Here you have a definition that starts from the term enterprise, that in that way funnels what can be included as an investment under the BIT. It's clearly intended to restrict the scope of the BIT. There are other elements of the BIT that also expressly limit what could be an investment, a qualifying investment under the BIT. But clearly this use of an enterprise-based definition is also a significant restriction on what is covered by the BIT.
Essentially, there are four elements there. One is that there should be a flow of capital, there should be an expectation of gain or profit, and there should be some acceptance of risk. These are the elements, and these have all been incorporated in the Indian definition. And of course then it goes on to elaborate the TPP as well as ours, that stocks and shares and intellectual property, immovable and movable property, and a host of other things would be included in the definition of investment.
Under Article 5 of the revised model BIT, expropriation is only allowed for reasons of public purpose, in accordance with the due process of law and on payment of adequate compensation. To ascertain whether a measure amounts to expropriation, the revised BIT has a list of factors such as economic impact, duration, object, context and intent of the measure.
There is always a problem with compensation in the sense that how do you calculate the compensation that should be made available to the investor. And I think the Indian model BIT strikes a fair balance, because it says adequate compensation and it says it should have a link with the current market value. And of course other factors also have to be taken into account. For instance, if land has been acquired a long time ago and a lot of appreciation of the land value has taken place, then to give the current market value based on only one or two transactions in the same vicinity may be a problem. I am just citing it as an example. So once you have a number of indicators or indices which have to be taken into account, I think it would come to the right figure.
The national treatment standard in the draft BIT did not apply to acts of regional and local governments and was criticized for being discriminatory towards investors. The government has taken some steps to address the issue in the revised text of the BIT, which now covers acts of state governments.
The national treatment standard in the draft, it was more restrictive. That stood out a little. to anybody reading that draft. I think there's been a reaction to that. I think the Government of India has taken advice on board, I believe, including from the Law Commission of India. What you have, therefore, is a national treatment standard that includes subnational governments. That will include state governments, which of course is important in the Indian context when so much authority and so much is devolved to the states. It still excludes local government, but state governments are in there. So certainly since the original draft, that national treatment standard has been opened up and made less restrictive.
At a time when many countries have grown wary of investor-state dispute settlement mechanisms, India's model BIT contains a refined investor-state dispute settlement provision that now requires investors to exhaust local remedies within 5 years before a party can commence an international arbitration.
I think the starting point for India is most reasonable. The need to modify its investment treaties going forward, and it is not the only state doing so. Australia for a while refused to have investor-state dispute settlement provisions in its investment treaties because of the claim that was brought by Philip Morris against the government of Australia. Indonesia is in the process of terminating all of its bilateral investment treaties. Germany has made noises adverse to investment treaties in recent times because of claims that have been brought against it in relation to its nuclear power industry, and notwithstanding Germany being the first country that entered into a BIT, and that was with Pakistan in 1959, and even the NAFTA states and the northern NAFTA states, the United States and Canada, have expressed concerns about their exposure under that particular instrument and other treaties. So India it is reasonable for it to want to modify and develop its investment treaty program.
What we are now saying is that local remedies must be exhausted, and we have put a time limit there of 5 years. So within that period, if the local remedies and recourse to the law courts does not yield results, then the investor is free to approach a tribunal. So to that extent, whether 5 years is too much, whether it should be shorter, that is a question which is open to debate. But if you look at investments, long-term investments, I think 5 years is a fair balance. It represents a fair balance, but it could be shorter. And then after that, there is this 6 months provision for conciliation proceedings or compromise solutions to be worked out. And within the next 6 months, you have to then file an arbitration claim. So in all the, when the clock starts ticking, you will need about 6 years before you can approach an arbitration panel. Provided there are no local remedies, you have exhausted the local remedies. In case there are no local remedies which are available, then an investor can straight away approach the panel.
Well, ISDS is controversial. There's a lot of pushback on that, certainly around the TTIP negotiations in Europe and North America. That said, of course, the TPP does embrace international arbitration as a dispute resolution mechanism. This draft also embraces international arbitration. You've got provision for ICSID and ICSID additional facility arbitration, where they become applicable, and UNCITRAL arbitration in the meantime. The inclusion of a requirement to exhaust local remedies is significant. It will be significant to investors, in particular in the Indian context, where of course the Indian courts do have a reputation and do create real difficulties for people in pursuing remedies. So I think if you include an exhaustion of local remedies provision in the BIT, that's going to be a standout point for people looking at it. Of course, that said, the Indian courts are subject to reforms at the moment, which it is hoped will make the whole process quicker, and it's the speed that really concerns people.
Although the model BIT casts an obligation on states to provide equal treatment in relation to compensation of losses suffered by investors in times of war or natural disaster, there's still no mention of two provisions which investors would have hoped to find in the revised text, that of most favored nation and fair and equitable treatment.
I think there are two things which we have not included in this BIT, and I fully support the government's stand on that. One of them is the most favored nation treatment, which has been found to lead to treaty shopping, and it has led to a lot of problems for India and many other countries, including Australia in the recent case of Philip Morris, where the Australia-Hong Kong Treaty was invoked. So that even the Law Commission has recommended that we should not include in our future BITs the MFN clause, because every BIT will have its own sense of balance and special factors which can lead to giving concessions to each other in the BIT. So that is one thing. The second is about fair and equitable treatment, which has been open to many kinds of interpretation, and that has also been excluded.
The omission of FET standard, again, people will note that. I think it does lessen the comfort level, because you ask yourself, why is the government not prepared to offer fair and equitable treatment? Of course, that definition itself brings with it a certain baggage. But I think that omission from the BIT will be significant. I think parties, other states, when they negotiate with India, will want to understand what that means. And of course, it's not just about inbound investment to India. These are bilateral investment treaties. It also covers outbound investment by Indian corporates into other markets. So the question is whether those Indian corporates will also want to ensure fair and equitable treatment in the markets in which they are investing, and whether that will adequately suit the interests of India Inc., as India becomes a capital exporting as much as a capital importing economy.
But that's not to say that there haven't been any investor-friendly changes in the model BIT. One such welcome change is the junking of a provision which barred an arbitral tribunal formed under the BIT from reviewing any case which has been settled by a judicial authority of the host state.
The government took on board many of the comments made by the Law Commission of India, including certain provisions in the draft which allowed the government to self-judge certain exclusions under the BIT, and also which prevented an arbitral tribunal deciding disputes under the BIT from revisiting matters that have been decided by the Indian courts. So I think this draft does give autonomy back to the investment treaty tribunal that is there to resolve disputes, and that must be a positive thing.
Now, the whole point of a BIT is to protect investors in India and abroad and to boost investor confidence. So the question is, has the revised model BIT succeeded in doing that?
It should be treated as a worthwhile exercise in developing a model BIT, and it reflects the sophistication of the Indian government and those that negotiate and draft these treaties, because we can see in the terms of the treaty that it's very much been prepared in light of recent jurisprudence and criticisms of investor-state dispute settlement. So it's a very sophisticated document, and one that I think is a worthwhile template for future negotiations.
You're looking at a draft here that is largely reactive to past problems with inbound investment, but of course you also have to balance those concerns with the needs of outbound investors looking at India's future phase of economic development. And I think that's a difficult tightrope. It's a difficult policy decision for the government to take, but clearly it has to balance up both of those concerns. They will become real once it starts negotiating with any given counterparty, and when it starts to look at the other state in question and whether it expects Indian investors to be going into that state. But this draft does start from a restricted point in terms of protections that the Indian government is offering, but also those that it is seeking.
I think it's safe to say that the revised model bilateral investment treaty is an improvement from the previous draft. Also, we must remember that the model BIT is only a template, and it remains to be seen how India's investment treaties will be negotiated in the future. In Mumbai, Aayush Ailawadi.
Well, this model BIT will determine whether foreign investors are buying into the Make in India story. We're going to take a quick break on the firm, but when we come back, will the Ishwar Committee's recommendations simplify India's tax regime?